Hi, everybody, and Erik here for Farmfolio, joined by Oscar Baracaldo, our CEO. And today we have something interesting for you. We're going to be talking about something that I'm sure is weighing heavily on everyone's mind, which is inflation. Inflation has been persistent, looking like it's going to be a lot more persistent than we've initially been told. Over the last couple of years, basically since COVID, we've seen a huge amount of inflation, some of which is reflected in the CPI, some of which isn't, and there are a lot of things to get into. But we want to cover it at a very high level today, just briefly. And what I want to start with is the recent announcement by the Federal Reserve, Chairman Jerome Powell, who said that there is likely to be another hike in the federal funds rate by the end of this year, and that the Fed is looking to revise down its rate cut projections for 2024 from four, I believe, to two. Which is fairly significant, and it's really affecting the market, especially the bond market. And that's what I'd like to talk about today. So I guess the first thing to start with is, these hikes, this will be the fifth hike this year. Once this last one goes through, it'll be five on the year. We're now looking at an effective federal funds rate of 5.33%, which, 2-3 years ago, was virtually nothing. I mean, we had basically a decade of near zero interest rates following the 2008 crash and the easy money era, as they called it. And it looks like we're finally seeing the repercussions of that. It looks like the proverbial chickens are coming home to roost. So I guess my first question, Oscar, is do you think that's true? And what do you make of this sort of inflationary environment that we're looking
at? Thank you, Eric. Hello, everybody. Welcome back to our blog. Looks like you had this was a moment you were truly waiting for. I know I'm just sort of unloaded on it. Really all loading a big one on everybody here. But no, absolutely. I have to agree. We've been talking about this. For me, inflation is scary. It really takes form on really what industry you're in or what industry you are currently invested in or exposed to. And at least for me during the last, I want to say 36 months, really, since pandemic and everything closed down. And I had conversations with so many about, things are going to close down. We're borrowing tomorrow's time, right? That. And, the bill's going to come to us, and the bill is due, right? And it's just how economics works. And we're here and we're facing the music. I think as a Farmfolio, we've been preparing about this asset class for the last 7 or 8 years since the first time we thought about getting involved in tangibles. With one of the most important theses for us, which was hedging inflation, and something that I've been tracking since last year to me was, inflation's coming. We're printing a lot of money. It's the easy money era, as you called it earlier, and we were all tuned into that, right? But to me, what was important was what kind of inflation are we in, right? And to me, was tracking the M1 money supply, right? And realizing what is this being driven by, and with today's microeconomics, and it's really hard to be able to really narrow down all the details. Definitely one of the key drivers were logistics, which were put to a pause or complete halt really during the pandemic. And we're seeing the repercussions of that, whether they want to tell us the truth or the entire truth is the inflation that we're seeing, the true inflation, or we're going to continue. And we're definitely on an inflation rally. We could have seen how throughout this year, U.S. policymaking has been looking towards being able to say, hey, this has been enough, this is crazy. But it looks like other countries are not following suit, and hence the rally continues, right? So absolutely. We're there where the bill is due. And at least from my perspective, in the conversations that we're having, this could be, 24 months, 36 months or more of a correction. And, I think we're going to get squeezed until, things deaccelerate, which I think that's what what this is all about.
Yeah, yeah. Well, there's a couple of things that you brought up that I wanted to touch on. One is, the persistence of this inflationary environment and sort of the contrast between, earlier this year, okay, inflation is transitory, and now this is basically a tacit admission of, okay, it's not as transitory as we thought. We're going to have to keep rates higher. That's going to slow down the flow of lending, and coupled with the logistical crisis and the war in Ukraine and all these things. But and the other thing that you mentioned is the inflation numbers that we're being given are not totally consistent with what people are experiencing. I mean, anyone who's gone to the grocery store the last year, the CPI, Consumer Price Index, is over the past 12 months supposedly 3.7%. But I just don't see anyone who has gone to the grocery store and thought, yeah, I'm spending 3.7% more, now than I spent last year. And so that's, it's having an impact across all sectors and, the bond markets, which we're going to be talking about in the future. But I think that really what this is a huge validation of our thesis coming into this, which was that, okay, farmland is an asset that's going to hold its value across cycles. We've seen inflationary cycles in the past where farmland has performed very, very well, yielding cash on top of that, and so to be able to, maybe that's why I was so excited at the start of this episode, because to be able to come out and say that and say, okay, we knew this was coming. I mean, I remember talking with you, at the outset of the pandemic, and when all of this QE was happening, all this quantitative easing and this money printing was happening. And we sat down and we said, man, this is going to have serious repercussions down the line. And they're going to have to raise rates, and, there could be a recession and all of these things. And, I love to say I told you so. I don't hate
that. Right. I know you're not one to shame away from that. Yeah.
No, I'm not one to shy away from that at all. And so, the validation and the proof of concept has really been valuable. But my next question is, where is this going? Because, you said 12, 36 months even of inflation, people are going to be starved for alpha and starved for yield in an environment where, just to outstrip inflation, zero risk, investments can't do that anymore. Government debt is not going to be able to provide that. And so where are people going to go? I mean, there's a lot of talk of commodities and real assets and all this stuff.
Sure.
Where do you think people are going to go looking for, the returns that they can't find?
Sure. Well, I mean, savvy people always go where they go during high inflation periods, right? That's tangible assets, real estate, and consumer staples, right?
Sure.
Which, at least from my perspective, and it all depends on what kind of real estate intangibles, but specifically, at least in our line of business, I can't speak for all, industries. One of the things that we like about this, although, during this period that we're in, can be very tricky for any industry, catching up with those inflationary, movements. But food definitely is there, right? I mean, one of the first things that are going to catch up with that inflation rally is food, right? I mean, as soon as inflation goes up, you go to the grocery store, guess what? Grains are more expensive, or produce is more expensive, and that's the last thing that you're going to take off the P&L of your household, right? You gotta eat,
Sure.
Right? So that's a good place to be at. That's the reason why we decided to be in this, and also being in land, right? Specifically, I would say that real estate, depending on the form, I said land, yes. I would say that construction can be a little bit of a catch-22, because if you're holding an asset that you're already constructed and that you're able to complete during a certain pricing of especially materials, which has been really tricky during the last 36 plus months, because I mean, all material prices have gone up, but they're moving upwards, sideways. It's a very difficult thing to keep track of, and you're starting to see a lot of these constructions and a lot of these projects that are starting to slack in actually coming to fruition. So again, it's timing. I think land is definitely a place to be at. That's what we believe in. We like land as an underlying asset, which will ultimately catch that appreciation. And if you talk to a lot of people that have been involved in farmland, sure, you got the cash flows that come off the trees, that come off or the crop, right? But ultimately, the underlying asset, if it is in a good location, and if it has got the prospect of being able to be rezoned in the future, say,
Sure.
5-10 years down the road, that's a nice, I think, sweet spot to be at.
Sure. Well, that leads me to my next point, which is that, we talked about the opportunity in commodities and production, but it also creates an interesting situation with respect to emerging markets. Being out here in Colombia, how do you think that inflationary pressure, that seems to be concentrated in the US, but is also happening abroad? How do you think that positions us, and what do you think the opportunity is there going forward for these emerging countries?
Sure, absolutely. Well, emerging means that there's a lot of upside, right? If you're well positioned to do it, if you're boots on the ground, or if you have the ability to work with somebody who's boots on the ground, like our team here in Colombia. Now, I think the US, for example, right? Because we do trade a lot of the US out of Colombia, and it's a good example to be able to extrapolate. Uh, I mean, free money and money printing was just out of the hatches in the US. So I think the problem really extrapolated forward faster in the US, and now the country it finds itself in a position where they're having to divest away from China. Right?
Sure. Yeah.
They're having to work more with their more neighboring allies, if you will, trying to take a lot of manufacturing to Mexico, trying to take a lot of the food production to Colombia. So a lot of that attention, a lot of those dollars are coming into those economies, right? Hence, land or any asset really is as valuable as whatever it is that you can do on top of it, right? As that attention comes into a country like Colombia specifically, not to talk about all, emerging markets, but this is the case for a lot of emerging markets. You're going to have a lot of that attention, a lot of that, more of that production, a lot of that price increase and dollar coming into foreign denominated currencies like Colombian peso, that will increase that value of land. And let alone in real estate property like managing here. During the last 2 years, you can see the real estate assets that have gone twice, 3 times, 5 times in value. And when you talk to people that have held farmland for 3, 5, or 10 years, it's very easy to hear extrapolating multiples of 3, 5 times plus just by it being farmland. If you start having rezoning, sure, you got to do a little bit of investment to create, communities, or, you're going to go with commercial real estate, but you can look at 15x, 20x on those property values in a period of 5 to 10 years. And those are not numbers that are outside our cards in an economy like Colombia. That's stuff that I personally see every day, and I've seen as a real estate investor in Colombia and other countries across the continent, especially in real estate in emerging markets, that those multiples arise because of those reasons. So because of the increasing attention of countries like the US looking to strengthen those relationships with nearshoring allies like Colombia.
Sure, and not only that, but as the return profiles sort of downsize in the developed world, people are going to look to other domiciles and other regions, for that alpha, those returns. But I want to leave it there. I think this has been a great conversation. I hope that people have found this insightful and feel a little bit better armed against this sort of inflationary cycle. We always talk about farmland as this sort of post-cyclical asset class, that can withstand cycles. And so that's the long and short of it. Hope you've enjoyed this episode of the Farmfolio blog, and we look forward to seeing you soon.